Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hello and welcome to the Smart Property Investment Show. I'm not Phil Tarrant, my name's James Mitchell, and I'll be filling in for Phil on today's episode of the Smart Property Investment Show, in which we've got a very special guest in the studio with us, Dr. Shane Oliver, who is the Chief Economist at AMP Capital. How are you doing, Shane? I'm
good, thanks.
It's good to have you in the studio. You've been a supporter and a contributor of smart property investment for a number of years. We were chatting just off air that I used to have regular phone conversations with Shane 7 years ago, and we've got a good working relationship, and it's great to have you here today. And one thing which I did want to kick off today's discussion about, I think we're going to talk about rates. We're going to talk about the property market and a little bit about what's happening in the forecast there. But I think one thing I did want to kick off with today is the Fed in America cutting rates for the first time since December 2008. And I know that all the papers and the mainstream press are making a big song and dance about this. I know that the ASX is tipped to rally and that sort of stuff. We can get into that a bit later. But Shane, from your perspective as an economist, what does this mean, the Fed cutting rates after so long? Why have they done it? What are the implications?
It's basically insurance. It reminds me of what they did back in 1998 or after the 87 share market crash. I don't think it's a situation like at the time of the tech wreck or the GFC when they were cutting because things were collapsing around them. This situation is very different. Basically, what the Fed has said is that we are confident about the US economic outlook, but our confidence has declined a little bit. There's more uncertainties around. High on the list of uncertainties is the trade war between the US and China.
Of course, yeah.
And then, of course, there's tensions with Iran. And we've seen softer economic data globally, all at the same time that America has seen its inflation rate, as focused on by the Fed, fall back below 2%. And that's given the Fed a little bit of leeway here, saying, well, we've got these issues, these uncertainties, inflation is still low, let's take out some insurance in case things go wrong. So that's the way I would see it. As is often the case with central banks these days, they have many avenues to express their views, and they confuse I think Fed Chair Powell confused the message a little bit in his press conference. Perhaps needs a bit of media training or something. I don't know what's going on there, but whatever it is, I get the impression that the Fed will probably cut again, but don't expect rates to go back to zero because I don't see the US economy going into recession. And I think that's the key point from all of this. I think it's good news for the global economy that central banks are doing something about those threats to the global economy. But at the end of the day, I'd rather the trade war went away and we resolved the situation with Iran and so on, solve the core problems. But often, as is often the case, the pressure falls back on the central banks to do something.
So more of insurance policy against geopolitical risks rather than a sign that the economy's moving in the wrong direction.
That's right. It's taking out insurance. It's like when, think way back, LTCM, a hedge fund, went bust in 1998, and the US economy was going gangbusters at the time. This was in the tech boom years. The Fed thought, well, LTCM could cause ructions in the US financial system, which could affect the economy. We don't know, but let's take out some insurance just in case, which is what they did. And ultimately, the US economy continued to motor along, eventually getting into trouble. But that was many years later with the tech boom eventually going bust. But they cut rates 3 times that time around in 1998, and I suspect they'll cut 2 or 3 times this time.
Compare that to what's happening in Australia. We've had 2 rate cuts from the Reserve Bank, June, July, and your forecast is for another cut this year.
That's right. Another one in November and probably one more in February of next year. I think the situation in Australia is...
It's not an insurance policy, is it?
No. We have slowed down and we have higher unemployment than America has, and recently it's been rising. And more importantly, we have higher underemployment than America has. If you add up unemployment plus underemployment, in Australia, it's about 13.5%. So we've got 13.5% of the workforce either unemployed or underemployed.
That's significant.
That's a high number. In the US, that equivalent number is about 7.2%. So we've got double the level of unemployment plus underemployment relative to the US. So little wonder that our wage growth is very weak at around 2.3%. In the US, it's not fantastic, but at least it's 3%, a little bit stronger. And of course, recently with the housing downturn in Australia, housing construction slowing particularly, and that all weighing on consumer spending, that's led to a slowdown in growth in the economy. So that's what the Reserve Bank is is moving against us. Our cycle's been a little bit different to the US one ever since the GFC. It used to be said, whatever the Fed does, we do as well. Well, that's not the case. We were raising interest rates in 2009. They were stuck at zero. We were cutting interest rates in 2011 to 2016 when they were doing nothing for most of the time, but then they started raising rates. We were still cutting them. And recently, of course, we've started cutting rates. So our cycle is a little bit different to the US cycle in this situation. And I think the case to ease in Australia is a lot stronger than it has been in the US.
Yeah. I want to ask you about what the new rate cutting cycle here in Australia, what the likely impact of that will be on the housing market, because we've had some recent conversations about this in terms of the wealth effect. And I've written a few pieces in terms of previous cutting cycles, for example, around 2011, 12, around then. And then we had obviously the boom of house prices in Sydney and Melbourne, and now rates are coming down again. What do you think the impact will be this time round? Do you think that the 2 rate cuts and possibly a third, maybe even a fourth, will create another boom? Or do you think that things are different this time round?
I think things are different. Rate cuts will help. A lot of people said, the RBA cutting rates, it won't help. Just look at the auction clearance rates in Sydney and Melbourne. It has helped. We were at a low of about 45% in the run up to Christmas last year. Now we're running around high 60s, low 70s in terms of the finalised clearance rates. Just always bear in mind when you hear the initial number that gets reported on Saturday night, Sunday, Monday, that's usually exaggerating a little bit. The final numbers are a little bit below that. But I think that tells us that rate cuts do help. And what's happened in Australia is we had that run up into the election, a lot of nervousness about a new government changing the rules around negative gearing and capital gains tax. And most of the estimates I saw suggested that could knock 10% off property prices in Sydney and Melbourne. A lot of investors stayed away for that reason. And then suddenly we had the miracle election, as the Prime Minister called it.
Yes.
Labor didn't win. All of those people who were thinking, well, this is going to be the beginning of the end in terms of the property market, sort of changed their view pretty quickly. And that includes me, I must admit, because I was quite negative going into that. If they won, combined with a whole bunch of other things going on in the economy, I thought we could have seen more declines in house prices. So I had to change my view. And then in the same week at the election, the RBA came out and said, well, looks like we're probably going to cut interest rates, basically. And then they did a few weeks later.
That's right.
Then we had APRA,
of course,
the regulator at
it was
the banks.
The trifecta.
Yeah. Now, you can debate the importance of all of these things, changing the interest rate serviceability test from 7% to something a little bit lower, rate plus 2.5%. Maybe that's not going to have a huge impact. But when you put it together with all the other things, you get quite a significant impact there. And yes, there's still negatives going through the economy. Those constraints are still there. But those positives, that trifecta has come in, combined with news of tax cuts, and that's helped stabilise the property market. So for the last few months, we've seen property prices on a national average stabilise. In fact, in Sydney and Melbourne, they've now increased very slightly, according to CoreLogic, for the months of June and July, 0.1%, 0.2%. Nothing huge, but they've gone up for the first time in a long time. So that's good news. But I do think this is a bit different to 2011 and what happened after that, and also what happened after the rate cuts of 2016, when the property market took off, house prices were growing 10% per annum, something like that. I don't think we're going to see it this strong this time around, or that strong this time around. Several reasons. Banks, I think, are a lot tougher in terms of their lending standards. So back then, we went into the period with interest-only loans. Everyone's getting an interest-only loan. Something like 45% of the loans being granted interest-only. Now that, I think, is probably not going to happen again to the same degree. A lot more focus on expenses on the part of borrowers.
Absolutely.
Income levels, total debt levels, all those things are still going through the system. APRA is still putting the pressure on there. So there's that aspect, harder to get a loan. Back in 2011, there wasn't a lot of construction going on. Now, there's still cranes all over the place, a lot more supply still to hit the market. So that's a big difference compared to the past. And then, of course, the New South Wales economy and Victorian economy, they were coming out of a long, difficult period through the mining boom. And that helped support their property markets. This time around, they've already been strong. If anything, they might slow down a little bit and unemployment might rise a little bit. So for those three reasons, tighter credit, greater supply, and possible rise in unemployment, I think the property market's going to be a bit more constrained this time around.
Yeah.
So next year, or over the next 12 months, I'd say price gains in the low single digits. Always going to depend on the area you're in. There's going to be a lot of variation around that. But I'd say low single digits, rather than, say, if you look at the relationship between clearance rates and house prices, you could say, whoa, 10%. That's what's happened in the past, given where clearances are now. I don't think that's likely. I think more likely low single-digit price gains.
Yeah, different environment. I think we're going to have to take a little bit of a break there, and we will be back with Shane Oliver talking about property interest rates, and we'll get on to business confidence as well. We'll be right back. All right, Shane, we're back. One thing I did want to talk to you about is business confidence, because it's an interesting thing, I think, when we talk about rates being cut, because the man on the street who has a mortgage, who has debts, would look at rates coming down and say, this is a very positive thing for me and my household. What's the impact on businesses in terms of confidence? Because I guess on a broader economic view, rates coming down is not a good signal for the economy.
No, it's not. It's the RBA is cutting rates because the economy isn't as strong as it could be.
Yes.
Things are weak. Businesses have not been, when they're asked in surveys, what is constraining you, they are not listing interest rates. So interest rates have never been overly high. That's not the constraint. But they do list a lack of demand. And I think this is why business will probably benefit from lower interest rates eventually, because to the extent that those low interest rates help people out there with a lofty mortgage.
Yes. To get that wealth effect.
Yeah. So go back a little bit. House prices fell, and even though they might be bottoming out, they're still down on where they were a year or two ago. That's having a negative wealth effect. Some people who borrowed a lot might be thinking, well, I've got to cut back my spending. I don't feel as well off. My house has fallen 10, 15% from the high point. I should cut back. Now, if you start cutting interest rates, that provides a little bit of an offset to that negative wealth effect. You know, they might still maintain their payments, but at least their debt's going down faster. And that sort of stops them from cutting their spending. So if anything, I think you'll probably get a little bit of a boost, because, the rate cuts seen so far, I mean, for many, with a $400,000 mortgage, you might get an extra $2,000 a year from the rate cut. So if you get more, it's going to be a little bit more than that. So that's, I think, going to provide some help to households and therefore help spending, which will ultimately help business. Now, if you look at business surveys, they've been running around average in terms of confidence. They were a lot higher if you go back 18 months ago. They have come down as retail sales have struggled, the economy's slowed. Recently, there was a little bit of an improvement after the election, maybe some of the election uncertainty going away, but we're still only a bit above average, or around average to a little bit above average. So I think there's still a lot of scope there for business confidence to improve, but you do need to see growth in the economy pick up, and hopefully that combination of interest rate cuts plus the tax cuts from the federal government will help achieve that maybe over the next 12 months.
Yeah. One thing that I've been thinking about is the RBA doesn't have much of a buffer left. I mean, its rates are at 1% at the moment. You believe there's going to be a cut around November time. Other economists, Bill Evans, for example, from Westpac, believes that there'll be another 2 by February. People generally believe that there's going to be more cuts. If rates are down around 50 basis points, let's say, or even 75, there's not that much room left before we get to zero. And then, we've got to start thinking about things like quantitative easing. Do you think that that's an option that the RBA is thinking about at the moment, quantitative easing?
It's certainly an option. And I think that they've got it on their list of, it's in their toolbox, and they're thinking about how they might deploy it. The reason they're doing that is they're probably thinking at the moment, well, we're at 1%, we've still got a little bit further to go. I think 0.5% would probably be the low for the RBA. So that means a cut in November, another one, say, in February. The reason I say 0.5 rather than 0 is that when the RBA cuts and the banks pass that on to people with a mortgage, just bear in mind the banks don't borrow from the RBA.
That's right.
They borrow from bank depositors in the wholesale money market. So what the banks have to do, if to pass it on to someone, they've got to cut their deposit rates. And of course, a lot of deposit rates are already close to zero. And so as the RBA cuts the cash rate, there's a limit to the extent to which the banks can keep cutting their deposit rates because they're already close to zero, or at zero. There's, I think, about 10% of them are at zero now, and they can't go negative.
No.
I don't think they will. So therefore, there's limited benefit to cutting much beyond 0.5%. There's some point there where the RBA will say, no point going much further because the banks won't be able to pass it on. If they do pass it on, their profitability will be challenged, which would probably mean less lending from the banks, and we don't want that either. So we saw in the UK, the UK is one of the only ones that did this. They sort of stopped their cuts, the Bank of England, before they got to zero, whereas the US went down to a range of 0 to 0.25 and the Bank of Japan and ECB went to negative interest rates. But I just don't see the Reserve Bank doing that. That's a lesson from other countries that maybe you don't want to put so much pressure on the banks that sees them stop lending or slow up their lending. So I think they will be thinking, well, maybe let's see what happens. We'll go to 0.5. If that helps things, then we don't need to do any more. But I think once they get there, they'll then be thinking, well, maybe we might have to do quantitative easing. What will we do? Quantitative easing is conventionally practiced in other parts of the world, US, Europe, Japan, and so on, has been about central bank printing money and then buying assets, buying government bonds, corporate debt, high quality rated stuff, mortgage-backed securities. And the hope is that when they get those assets, they get that it comes onto their balance sheet, but they've also injected printed money into the economy. The hope is some of that printed money gets lent out or spent. Now, the evidence as to whether that's worked or not has been somewhat mixed. I'd say it probably has helped, but it's not as guaranteed. It's not as effective as it perhaps could be. And obviously the Reserve Bank would be conscious of that. So they're thinking, well, we could do some of that, but how effective is it going to be? I think at the end of the day, a more effective approach would be to work with the federal government, which is where you say, okay, we're going to print some money, we're going to give it to the federal government in some way, and they can use that to provide checks in the mail to Australian households, or they could spend it on infrastructure or do things. There's two benefits to that: guaranteed impact on the economy, and it could be fairer. Because the problem with quantitative easing in Europe and the US and so on is you could argue it's unfair because low interest rates, bad for low-income earners who have a lot of their money in bank deposits, but low interest rates, good for shareholders, and they tend to be higher-income earners. So it perhaps not as fair as it could be. So working with the federal government could be a more sensible approach. Question is whether the federal government wants to do that. There's all sorts of issues about using printed money to finance government spending, thoughts of the Weimar Republic in Germany in the period between the two world wars and so on and so forth. So there's issues there, but I would think that the main issue is, well, this could cause hyperinflation. Well, if your problem is that inflation's too low and your economy is weak,
probably not a bad idea.
That's not a bad. It's not a bad idea to do some of that. You wouldn't do it en masse, but you can do some of it. But I think there really is a role here for the federal government to do more. And a lot of that, I think, is around infrastructure. At least they're effectively doing some of the checks in the mail now, the low and middle income tax offset. But they may have to do some more down the track. So yes, QE I think is in the toolbox of the RBA. They're thinking about it, but I also think there's probably better ways to do things than what the Europeans, the Japanese, the Americans and the English have done.
We're going to take another short break and we'll be right back with Shane Oliver talking about interest rates, and we're going to move on to the Australian share market and what the forecast is there. We'll be right back. So Shane, I did want to speak to you a little bit about the ASX because some of the fund managers and big houses that I've been speaking to have sort of been waiting for this announcement from the Fed and basically expecting renewed resurgence in the ASX, which is looking pretty lofty at the moment. What are your views on today's decision by the Fed to cut rates? What impact will that have on the ASX? And what's your forecast for Australian shares, I guess, from now until the end of the year?
Ultimately, I think lower interest rates are good for shares. History shows us that interest rate cuts help as long as there's not a recession. So if you go back through history, back to the early 1980s, look at the 8 interest rate easing cycles in the US. Through that period, 5 of the 8 have seen share markets higher at least over the next 6 months or the next 12 months. And it's a similar story in Australia. Now, the occasions when it didn't happen was when America went into recession, the tech wreck and the GFC and I think the one in the early 80s. So there's been some exceptions to that. So whether you get a recession, that's the key issue here. I don't think we're going to have a recession. I don't think we've seen enough excess in the US. By excess, I mean excessive spending or excessive debt or inflation. We haven't seen those sorts of things that normally precede a recession. And likewise in Australia, housing is turning down, but I don't think that's going to be enough. Housing construction, I should say, turning down, but I don't think that's enough to cause a recession. So I think ultimately interest rate cuts in the US and Australia will be good for shares. The reason that is because it makes shares look cheaper. compared to, say, bank deposits. And it also adds to the hope that growth down the track will pick up. Short term, it's a bit more uncertain. What's going to happen in the next couple of months? That's always an uncertainty. The initial reaction to the Fed's move was actually for the US share market to fall. I think that was because Jerome Powell, the US Federal Reserve chairperson, confused things in his press conference. Maybe he should stop doing them, but as I was saying before. So there's a bit of an issue.
Very powerful press conference if it impacted the market negatively.
Yeah, that's right. It's quite, you sort of wonder why do this. They used to not do these things. There's an argument they should be more transparent.
Right.
But I wonder whether the transparency has just turned into confusion.
Yeah.
And you could argue...
Some PR team got hold of them, told them they need to be more transparent.
That's right. I kind of wonder whether someone needs to be sitting on the sidelines with a little buzzer or gives him an electric shock when he says the wrong thing. Don't say that. But anyway, be that as it may, the short-term reaction.
Yes.
I should also point out the Aussie share market has made it to an all-time high recently, finally getting back to where it was in 2007. That doesn't mean we're in a bubble. If we'd gone to an all-time high every year for the last 10, then we might be in a bubble. But taken us
returned 12
years to get back to where we were, so that's more a recovery. But having gone up there, we've come up very quickly recently. We're up 20, 21% year to date.
Yeah.
So after such a huge run up, it's quite possible you go through a short-term correction. Maybe concerns about
people take their gains.
Yeah, take their gains. I'll take a bit of money off the table. Let's wait and see what happens. We're coming into August, September. Guess what happens historically? They've been volatile times of the year in share markets. We've got these concerns about trade. We've got the concerns about Iran. And maybe we'll go through a bit of a pullback, and that can become a bit self-fulfilling. So short term, I am feeling a little bit cautious about things. But by the end of the year and in 12 months' time, I reckon share markets are going to be higher, both in Australia and also internationally.
Yeah. It was interesting to see the share market reaction to Morrison's victory in terms of the election this year. Did you find that, I guess, out of character? I know that you did some analysis, actually, haven't you, in terms of election wins and the impacts on share market?
That's right. Sometimes you can see a little bit of nervousness going into elections because...
There definitely was with this, I think.
Yeah, there was. Investors are fearful as to what might happen because don't forget, Labor's policy was changes on capital gains tax, negative gearing, trust structures, a whole range of changes around tax, potentially more regulation of the banks, all sorts of things that share market investors were a bit wary of. And I think investors didn't know who was going to win, so they priced in some probability that Labor would win. Suddenly we get the election outcome. It wasn't as many expected, and they've got to reprice the share market. So you saw this instant bounce up in the share market. And you can argue that was perhaps one of the key triggers as to why we've got to the 2007 high so quickly. It was the election outcome. So if you combine a favourable election outcome, at least in the view of investors in the share market, with interest rate cuts, all contradicting the uncertainty that prevailed prior to the election, you can sort of understand why the share markets suddenly had this leg higher. So I think the election has played a big role here, not just in the property market, but also in the share market.
Yeah, very good point. I think we're just about out of time, Shane, but I know we spoke about housing a little earlier in the show, but just as, I guess, a sort of recap, what are some of your main predictions going forward, let's say, the next 12 months for real estate in Sydney and Melbourne? I won't go across Australia, but for Sydney and Melbourne, the two biggest housing markets, where do you see things going?
I think we're into a very shallow recovery here. It could have fits and starts, but I think we're into a shallow recovery. I'm perhaps more confident about Melbourne than Sydney for two reasons. They don't have the huge supply of units hitting their market, and their rental vacancy rate is still below average. And they've got strong population growth. So I have a feeling they'll bounce back a little bit faster. If you're going to sort of fine tune it, Melbourne prices could be up, say, 5% or so over the next 12 months. Sydney, though, I think is probably a little bit more constrained. It's got slower population growth, about 1.5% New South Wales compared to, say, 2.3% in Melbourne. But more importantly, there's still a lot of units to hit in Sydney, and the rental vacancy rate in Sydney has been going up quite sharply. It's the inverse of Perth over the last few years. The Perth vacancy rate has been crashing, surprisingly, and the Sydney one has been going up quite dramatically. That, I think, will constrain the Sydney property market. So I'd say Sydney could be up 1 or 2% or so over the next 12 months. So that's why I say it's low single-digit gains.
Very, very modest gains.
But fairly modest, but I'd be a little bit more confident about Melbourne. I'd probably try and focus on areas of the market where there's not a lot of units coming on. That's probably a key thing in all of this. You might argue in favour, that argues in favour of the better off neighbourhoods because you don't have the units coming on. But then a lot of the people who live in those neighbourhoods have money in the share market and they're feeling wealthier because the share market's gone up. So that might help spending in those parts.
That's a good point. I was wondering if, in terms of having that window of time to save for deposit for those people who might be listening, who are looking to get into the market, whether they're as an investor or owner-occupier, and they're thinking property prices have come down a bit, they've cooled. Do I still have time to get my deposit together? Do you think over the next couple of years, there's still time for those looking to get into the market to get their affairs in order?
I think there is. I think this is going to be a lot more constrained because the bank's going to be slower in providing the lending, and it's going to be more, the total amount people can borrow will be less than it once was. So that will slow things down compared to past cycles. And I hope that will be the case. I think it will be incredibly unfortunate for Australia if house prices just take off again. We're up 10% next year and 10% the year after. I think that will be a social problem for Australia. But I don't think it will be like that. But I think there is a bit more time for buyers to sort of consider where they want to go, make the best choice they can. At the moment, auction clearance rates have picked up to around 70%, so substantial improvement there, but it's on low volumes. I suspect as time goes by, the volumes will start to improve, so there might be a bit more choice on the market than there is at present point in time. So that combined with tougher lending standards, I think does mean there's a little bit more time for particularly first-time buyers to sort of consider getting into the market and where they get in.
Yeah, very good point. Shane, it's been fantastic to chat to you. And thanks very much for your time. We'll have to get you back in the studio soon. That's all we've got time for on today's episode of the Smart Property Investment Show. Of course, for all the latest news, analysis, features and hotspots on Australian property, do check out smartpropertyinvestment.com.au. I've been your host, James Mitchell, filling in for Phil Tarrant, and we'll catch you next time.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.